Hello, everyone. I am going to get started this week, just really talking about um, some of the things that have gone on today, some of the things that Jerome Powell talked about. And then I'm going to shift and transition to stocks. We're going to talk about bear and bull markets there, and then just kind of tie all of that into how to pick stocks, learning about market conditions, and that sort of thing. So I'm gonna go ahead and share my screen so we can get started with the Forex Factory calendar. So yesterday we had speeches from Jerome Powell, and for the most part that went okay. I will say that Jerome Powell is definitely, he's gotten a lot better with his speeches and how he answers questions. But I do, and I have noticed over the past couple of speeches that he's given that a lot of the information he's given, he goes back and changes it at some point in time. So my thought process now is that he's just trying to give information just to get the question answered, and then he can just kind of edit and go back and revise as needed. Normally with the Fed, they'll give you a solid answer and that's what they stick to. A lot of the things and a lot of the seams and threads along his speech that have been consistent over the past like 16 to 18 months have been interest rates and inflation. We've talked about those things already, so I'm not really going to go back over them. But just know that the Fed doesn't really have any strong intentions of changing a whole lot of what's going on now. They're playing like the wait and see game. He was asked a question yesterday several times in different ways about how or what his thought process was behind the stimulus packages. He feels that there is a need, but how much, how it's going about, how Congress is configuring the whole deal. He didn't want to give too much of an answer towards that because he typically doesn't answer questions along those lines because it's not something he can just physically put his hands on. Several times he highlighted yesterday the need for the increase of employment in minority groups. I put it in the group chat yesterday that he's now calling minority groups and those who are underprivileged, like the lower quartile. Because every time he mentioned the lower quartile, he had to go back and then explain what he was talking about in the lower quartile. And he was always either talking about Blacks, Hispanics, or in certain conversations, those who were underprivileged. So I'm thinking like now, okay, now we're starting to change the language, starting to really get into a new administration, new language, not trying to step on people's toes and hurt people's feelings when these reports and stuff come out. So if you say lower quartile, you're not necessarily excluding those who are in other groups that are underprivileged, underserved. But we kind of know who you're talking about as the majority. So anyway, that's what I took away from that yesterday. And then we also got consumer confidence news. Consumer confidence news was good. The expectation was that it was going to be better than last time. Part of that being we just finished up an election. Anytime you finish an election and you're coming into a new administration, the hope is always high. Also, the fact that Biden came in talking about a new stimulus package, getting money to the people, and just really trying to elevate the people. Like that was a lot of things that he ran off of, especially towards the end. And so people were really excited about that. So now it's a matter of execution and making sure that the promises are lived up to. New Zealand did not change their rate yesterday. And then today we got more testimony from Jerome Powell. For any of the questions that he did not answer, he deferred. He has like 30 to 45 days to answer those in writing. And when he answers questions in writing, they do go to the Congress website so that people can see those. Crude oil inventories was a little off. not surprising. We just came off of a time where we were taking reserves out, and now we're having to kind of fill our reserves back up again. And I don't really take this 1.3 million as a sign that we're hoarding oil again. I just take it as, okay, we literally just dumped almost 7.5 million barrels over the past several weeks, and now we're just filling up the reserves again, giving these oil companies time to get back online, time to build up the nation's reserves again. So that's not a real big deal to me. And then I'm just gonna pause a little bit, talk about some other stuff that's happened. So earlier today, around, actually, it was kind of coincidental the time that it happened, like right when it was right when London session was closing. We had an issue with our federal banking system. It's an issue that should never, ever happen. So they're trying to investigate why it happened, but essentially the federal wiring and accounts communication system went down for 3.5 hours. Because that went down, there was a systemic, how can I put it? As far as accounts being paid on time, people being paid on time, because remember, that's when London session is closing. So we have to pay up any money we've owed to London overnight that we borrowed, that we now have to pay back, any type of payments that have to be made before London's closed. All of those different systems that are in place that help ensure that we get those payments made, it went down. So there were accounts that essentially bounced back and got like a non-sufficient funds. And it was only because the account couldn't be accessed. So it just went straight back. So these wiring systems, there were like 21 systems that were affected during this time. As far as how it happened, who did it, all of that stuff, whenever I find out, whenever it comes on the news, we'll all be able to figure out what happened there, but that is not cool. I also think it's kind of coincidental that it happens just a day after Jerome Powell talks about digital banking and having a digital currency, and how the government has been working towards that, how he doesn't want to be the first, because we are the world's major backup currency, so to say. Backup meaning like to another country's currency, but we are the major floating currency in the world, because no commodities trades can happen in the world without USD, because all commodities trades are done in US dollar. So that was one of the primary reasons why Jerome Powell is saying that, the US is looking towards this, is moving towards this. We don't want to be the first to officially have something like this out. I get the premise, I get the thought process behind that, but at the same time, because we are such a major currency in the world, we have to at some point start moving towards the front of the line when it comes to creating this digital currency. Just because if we allow other countries to do so ahead of us, they can then stake claim on being the dominant currency for commodities and take over that market from us, which is possible if you have enough players and you have enough people and you have enough money, which China and Russia both do, and they both have already worked towards and have some type of digital currency system going in their country right now. So we'll definitely be keeping an eye on that. So I'm going to switch gears and start talking about stocks now. If you have any questions, you can just put them in the chat, and then I'll pull the chat up and we'll go through that at the very end. So what I want to focus on tonight is the bear versus bull market. So Abraham Lincoln said it best. He said, the best way to predict your future is to create it. So that's part of what we're doing here, showing you how to make the best future for yourself, giving you the tools to actually go about creating it. So bear versus bull markets. This is going to be important for not only stocks, but for Forex, for options trading, any type of trading or investing you ever decide to do in any market. Bull versus bear markets are important. So what are they? So to just sum it up and make it really easy for you, it's an increase or decrease of 20% off of the market's high or off of the market's low. So in a bull market is a 20% increase off of the market's low. And a bear market is a 20% decrease off of the market's high. So if you, I want you guys to think back to March of last year where you saw the stock market just kind of plummet. Market hit somewhere between like 17, 18,000. And then now the stock market is at like 31,000. We're in a really strong bull market right now because that's definitely 20% increase off of that low of about 18,000. So like I said, this can happen to a general market. It can happen to a stock. But if you're talking about a stock, it might not necessarily be called a bull or a bear market. You might just hear an analyst or might read an article that says that a stock is bullish or that, you know, it's hitting all-time highs, or they might just talk about the fundamentals, that the company's expanding, that they've come out with a new product, that, you know, they're reaching new markets around the world. So it might not necessarily be called a bear or bull market. And as you'll see on the next slide, bull markets tend to last 5 times longer than bear markets. So we'll take a look at this because I just want you guys to like really put this into perspective. And I'm really trying to help to make this stuff like common sense for you so that you don't have to like overthink these concepts. So this is a chart going back to 1942. It was found at First Trust. They do a really good job of just covering market analytics. They do all the analyzing for you. They put all the numbers where they need to be. So all you have to do is just literally look. So the blue that you see here in the middle, those are your bull markets. The yellow are your bear markets. So if you actually look, when the market started, we started in a bull market and then had about 11.6 months of a bear market, followed by 1.1 years of a bull market, followed by 11.9 months of a bear market. So as you can see, as we go through time, these bull markets are getting longer and longer, and the market's reaching higher highs and higher highs and higher lows. We're making uptrends as we're going through this period of time. And what you're seeing here is percentages. Those are the returns during that period of time. So the biggest takeaway from this is that if you can identify when the market is in a bear market, it's not necessarily trying to get in to short the market, but you're just trying to identify when this bear market is happening. You can do 2 things when you identify a bear market. You can either pull your money out, which is what a lot of people tend to do, but then you forget to put it back because you're scared. So you could pull your money out of the market, or you could leave some of your money in and take some of it out and take some partial profits where you are. Wait until you see the market start to turn around and make those aggressive higher highs, higher lows, and then get back into the market at a better price and then ride the market up. And as you can see, because we are talking about these bear markets being only about 1/5 of the time of bull markets, whenever you get into the market at the very beginning of a bull market, you know, for the most part, that you're getting in at the very beginning of what could possibly be a good run in the market, where you're going to be getting in, price is going to continue to make higher highs, higher lows. You're going to be making money as time goes along. This is also another principle behind long-term trading. So when we talk about long-term trading versus short-term trading, this is another concept to really keep in mind, because if you get in the market as a new investor in the middle of a bull market and you see your money increasing, and then all of a sudden a bear market happens, you don't want to just necessarily take your money out and run. If you're a long-term trader, you're in there for at least 5 years. So let your money do its work. Let the market do its thing. If we hit a bear market, that would be the time to say, okay, do I have money and savings that I could put in at this point in time and possibly ride into this bull market and make more money? So I want you guys to keep that in mind when we talk about these things happening in stocks. If you pull up a stock chart and you look at all the highs and lows, those mountaintops and valley bottoms, you see the exact same thing. You'll see how stocks do the exact same bull and bear market runs. Also, when we're talking about bear and bull markets, you will hear these bear markets called like recessions, deleveraging. And then with the bull markets, you'll hear them called reflationary periods. You can hear them being called market run-ups. There are lots of different names for these terms. But what I want you guys to also think about is when you hear someone talk about a recession means a lot of things in economical terms. It means that businesses are starting to slow down. Jobs could possibly be lost during this period of time, and the economy is slowing down. So one thing I'm going to show you guys how to do tonight through sectors is how to diversify your account to get through periods of time like this. So you know, okay, if a bear market is coming along, like, how do I position myself? If I want to continue to own stocks, how do I really position myself so that I can still make money in a recession? So before I do that, why is it important? So you want to be able to broadly anticipate a bear market. You can't just look at a chart and know, okay, a bear market's coming next year or the year after. There will be little indicators and little hints here and there of things to come. I reference this a lot, but those of you who were with us, you know, in 2019, we were telling you guys that something was getting ready to happen because of how the Fed was acting. Had it not been COVID, it would have been something else, but our economy was already teetering on the brink of a recession in 2019. And so even if you can't broadly anticipate a bear market, you want to be able to position yourself for the bull market to follow. So there again, if you know we're in a bear market or coming out of a bear market, how can you position yourself to win? And then you also just want to be able to know and look at a chart and kind of recognize market cycles, because everything happens in cycles when it comes to the economy, when it comes to stocks, any type of market you're looking at, everything has a cycle. All right, so for the diversification, so you can diversify your portfolio in many ways. We've talked about a few of them before. So you can diversify them with sectors. You can diversify your portfolio based on regions of the world. So you can choose to own American, Canadian, European, Asian stocks and spread your money out across the globe. And then you can also diversify broadly in investing across bonds, stocks, cash, real estate, and commodities. So for sectors, for the most part, there are about 11 different sectors you can look at in the market and diversify across. So you have information technology, So these are companies that develop or distribute tech and tech services. These services could include internet, those computer, tablet, processor manufacturers, and then operating systems. So like Microsoft, Oracle, those are two good ones for information technology, because Microsoft heavily depends on the internet. They have the Internet Explorer. So they actually have a platform where people can go and use the internet. HP is another one. So, you know, when we're talking about information technology, think about computers, think about tablets, think about the operating systems that those computers and tablets are running off of. Apple fits into this category solely because of the operating system. But as you'll see as we go through these, there are some companies that fit into multiple sectors, which is fine. Whenever you go in and look at what a company mainly does, that's going to be the very first sector that you'll always see, but it could possibly have one or two others listed below that. So to move on, healthcare. So these are companies that make healthcare supplies, drugs, 3D, medical printing companies, anything scientific, where we're talking about research. Those companies fall under healthcare. Johnson & Johnson is a big one. I've talked about them before. They are a medical supply company. They're also a pharmaceutical company. Anytime you buy Tylenol, you're buying a Johnson & Johnson product because they own Tylenol and make it. And then scientific operations, because they are in the medical device field, they are kind of broadening out into making and doing things with robots in the operating room. So they kind of fit all three. Pfizer is a company that would fit under pharmaceuticals. Medtronic is a company that would fit under scientific-based operations. And Kimberly-Clark is a company that would fit solely under medical supply companies. Financials, everyone's favorite. So these companies are finance, investing, they store money, they're banks, credit card issuers, credit unions, insurance companies, companies that hold mortgage REITs, which are the real estate investment trust. I put Berkshire Hathaway as one, but these could be Visa, MasterCard, JP Morgan, Goldman Sachs, Bank of America, any company that does investing, finance, banking, has a card. So whatever emblem is on a card that you use or swipe every day, they're traded. So one thing about financials to remember is that because everyone has to use money, everyone has to transact in some sort of way in order to just sustain daily life. The financial system is not going anywhere. We have whole government departments and groups dedicated to financials. They're not going anywhere. So financials for me, I always have at least one. I like Visa and MasterCard in addition to some of the companies in the US, because Visa and MasterCard are trying to break into the Asian market. They don't have a really strong presence in Asia. So if they can really become popular in Asia, that will be very good for them. So those are two that I'm looking at in addition to Berkshire Hathaway. And then consumer discretionaries. So I really like this group because this is essentially like a luxury group. So you don't necessarily need anything from this group to survive. But when people are purchasing items out of this group, it's a really strong indicator of, are we recovering well out of a bear market? And it's a measure of wealth, so to say, because they are items you don't need to survive. They're just items people want to have. So when we're looking at the consumer price index and the purchaser's price index and consumer spending, we're looking at consumer discretionaries. So those companies that fall under consumer discretionaries, those are the companies we're looking at when we look at those numbers on the Forex Factory calendar. Because companies like Starbucks, Tiffany's, Best Buy, Expedia, Priceline, people don't have to take vacations or stay at hotels or buy cars or jewelry or anything like that. Those are things people want to have. So when we're looking at how well is an economy moving forward, how energized is the economy going to be, just look at discretionary spending. Because if people have the money, they're going to spend it at these places. I use Starbucks as an example because when people have money, people are going to stop at Starbucks. Starbucks is like $5, for a cup of coffee on average. So whenever you're looking at people spending, coffee is one of those things where I'm like, all right, if people are spending money for coffee, the economy must be pretty good, because people could either wait until they get to work, go to a gas station, or simply just make the coffee at home. It would require you to wake up 5 to 10 minutes earlier, but you can make the coffee at home. But you have the $5 to $10 to spend every day, 5 days a week. No, we're doing pretty good. So just always make sure that when we're talking about coming out of a bear market, going into a bull market, that you look for something in discretionary spending. A lot of people are talking about wanting to go on vacations. So Expedia, Priceline, American Airlines, Delta, United, the insurance companies that people are going to file travel insurance claims with, like Travelers. Let's see. Car. So Tesla would fit into this group, but Tesla also fits into information technology. Tiffany's, I named them. Electronic devices. Apple kind of fits into this group because they have devices. So just make sure you're finding one that is good. And I'll talk a little bit more about that towards the end when I completely finish. But finding one that's good, finding one that has an advantage over another. So out of all of these, if I were looking to build I don't want to call it recession proof because it won't just be proof, but if I want to build a portfolio that will help me to weather a recession and get out with as little loss as possible, or maybe even some gains during that period of time, information technology, because you have to think the internet, we use it for everything. We use it for transacting business. We use it for Facebook. We use it at work. We use it at school. That's not going anywhere. Healthcare, a lot of people would say they would put healthcare in there, but if you look at how people tend to spend their money in a recession, people tend to not go to the doctor unless it is like a dire emergency. And when I say a dire emergency, I mean like they literally have to be dying to go to the hospital during a recession. Last year, when COVID first started, there were actually hospitals that were shutting down portions of their departments because they were having to divert staff, either sending them home or using staff to cover COVID units. So some of the healthcare companies didn't fare too well for several of those reasons. And then also insurance companies, health insurance companies don't really fare that well during recession, solely because people are like, that's an expense I don't want to have. I'll just pay the IRS penalty. Financials. Financials are a sector where essentially when we're looking at a recession, it could go either way for financials. So back in 2008, financials did horrible. Last year, during our slight recession that we had, financials did great. So it's a matter of trying to look to see what is this recession coming from? What happened and where are we going from here? Consumer discretionary spending, like I said, this will be something that you would buy coming out of a recession, going into a bull market. So I saw the question that was in the group chat. I wanted to cover it on the next slide because I actually had Kroger on that slide. So I'll cover it when I get to number 7. But consumer staples is different from consumer discretionary because consumer staples is actually stuff that we need. All right, so communication services. So these are companies that actually help to keep us connected. So these will be internet service providers, phone plan providers, media, entertainment, interactive services and such. So Netflix, Disney, those Verizon, AT&T, those are all examples of communication services. During recessions, during times of market pullbacks, these services are needed. Zoom falls into this category. And if you look at what happened during our last slight recession that we had, Zoom was actually, it was what most companies and schools use to help stay connected. So that is definitely an area where you want to pay attention during a recession. Industrials can go either way. So these are companies that help to transport, military items. So it's about 14 different industries that are within this sector. Aerospace and defense engineering are big in this area. Boeing is a company, Alcoa, Allegheny Technologies. The airlines that I mentioned on the last slide also fall in here. So it's just a matter of knowing the companies and the industries, but then also thinking about what's going on. So like with COVID, travel is restricted. So this wouldn't necessarily be a good area. But if the recession is because of the financial industry or the banking sector, this industry might not be that bad because people still have money. It's just the banks are having a hard time on their end. So to go to the question about Kroger that was in the group chat. So Kroger falls under consumer staples. Consumer staples are the companies that you have to have. So people need them to sustain daily life. So these are companies that are going to be providing your food, beverages, are going to be providing a place to buy these items, personal products, household items and stuff. So during the last recession, so when I say last recession, I'm just referencing back to last year, essentially. Procter and Gamble and Kroger were two big companies that were featured, highlighted, and did very well last year. So Procter and Gamble makes things like Tide, your laundry detergents, your dish detergents and such. And then Kroger is the largest grocery food chain in the United States. So we're talking about the places where people go to buy items. Well, you're going to go to a grocery store. You're going to go to a Kroger. You're going to go to a Harris Teeter. You're going to shop at one of those places. And so consumer staples thrive. So because you know that there are items that are necessary for life, those items aren't going anywhere. Those companies aren't going anywhere. If anything, those companies merge together instead of just completely going out of business. So in a time of recession or in a time of market boom, I always have a consumer staple. I always have at least one or two, solely because I'm like, well, people have to have those things or people have to go there. It's not going anywhere. So that's to me like a given. Energy. So these are companies that play a part in oil, gas, and consumable fuels. So like still your kerosene, solar companies fall in here, electric battery vehicles for your electric vehicles. And then also the companies that manufacture the equipment to find, drill, extract, refine, and pipe. And then also the companies that find, drill, extract, refine, and pipe these resources. So ExxonMobil is a really good one. ExxonMobil, Chevron, Marathon Oil, First Solar. Those are really good companies in this sector. Most of those are based out of Texas. And then First Solar, it was really, to me, one of the first solar companies that I saw on the market that had a really strong plan for how they planned to expand the solar market in the United States and internationally. And I was looking at that company back in 2009, and I've watched their stock grow from $1 to now it's about $96 a share. So that company is doing very well, and will continue to do well because under Biden's administration, Biden wants to move towards green, clean energy, and solar fits right into that. Also, companies that have wind farms. We don't have many wind farms here in the United States. They do in Europe. But companies are starting to look towards developing wind farms here in the United States. And when they do, that'll be another great source of energy. And then for the last three, utilities. So I hit on this a little bit on the last Zoom call, but companies that provide electricity, water, and gas. So Duke Energy will be one that falls under this. Utilities aren't going anywhere unless, of course, there's an outage. People are still going to need to use utilities during a time of recession. I didn't mention anything about that for energy, but essentially in a time of recession for energy, one thing I want to highlight is that we have to be careful with energies, and we have to think about pricing, the prices of items during this time. So if a company says we have to cut back our staff, and let's say, for instance, that staff that they're cutting just because of pay might be truckers. Well, that means that it's going to take more trips on the truckers that they have left to get supplies back and forth. And energy costs amongst that one truck might not seem like a lot, but the wear and tear eventually will cause energy prices to be higher on that truck. And prices will be higher, essentially. So there are a lot of different ways energy can kind of go awry in a recession. Last year, we watched oil go into the negative. That was not a good thing for oil companies because they essentially were having to pay companies to store their oil and essentially get it off their hands. They had so much that they couldn't do anything with it. So that's not a good thing. On the consumable side with the green energy, that energy to me is growing. So they're in a recession in times of need and times of market inflation. So we've talked about inflation a little bit. During those times, green energy is going to thrive. I'm not biased towards green energy. I just like energy all the way around, but there are a few reasons to me why I like green energy. First of all, right now is the administration and where we're going with this administration. The carbon tax and different taxes that I see that they're proposing for people who don't have green industries and companies. I see that making the shift a permanent thing. I also see our relationship with the Middle East starting to get a little shaky again. So green energy for that reason is going to be important. And then because there were already initiatives that were put forth during the end of the Bush, the beginning of the Obama administration that pushed and wanted companies to move green. Companies had already started making that transition anyway, not only with their vehicles, but with their factories, and then also with different types of fuel. So there are companies in the United States who are getting energy from Brazil because Brazil makes their oil from plants and from crops that they grow. So energy during a time of recession, in my opinion, green energy is great. Oil might get a little shaky solely because of where it comes from, our supply and resources of it here in the United States. And then also if jobs are cut, if supply chains are damaged, then we could have an issue with inflation solely caused from oil itself, not green energy, because green energy will always be there. So like I said, with utilities, kind of getting back on track, you always need utilities. So I don't see utilities going anywhere. Real estate is another sector. So real estate is one of those sectors that always takes a hit during a recession, for the most part. For the most part, recessions tend to hurt real estate, because when you think about what the real estate market is made up of, it's made up of the realtors, the home builders, the construction companies, and then the real estate investment trust. And this is for commercial or businesses, and then also residential. During a time of recession, when you think about what's actually going on, people are losing jobs. Either they're being laid off or permanently losing their job. Pay is being cut. And there's a lot of uncertainty in the market. So when there's uncertainty in the market, people are not wanting to buy large purchases. Anything that they do is going to be short term until they find out what's what, who's who, and where they can safely put their money. So people aren't going to go out and say, yeah, I'll dedicate, the next 30 years of my life to paying towards this house. They're not going to do that. Also, a residential builder for a subdivision, also companies and corporations, they're going to take a step back and say, well, do I really want to build this factory in this city when we're in the middle of a recession? A lot of people might say, well, you're $1 billion company. Sure, you can afford to put this factory there and hire people to make your products, but then who's going to buy the products? You're in a recession. People are cutting their spending. People are analyzing what they're spending their money on more and more. So the products that you're manufacturing, people might not buy. So a company is going to be very leery of trying to put a new factory or headquarters or whatever anywhere. So that's why real estate tends to take a hit during a recession. However, whenever we get ready to come out of the bear market, that is when real estate booms, because people are like, my job was safe during that time. I've saved up all this money. Let me go spend this money. Let me go buy land. Let me go buy a house. Let me go get build that office for my business. Let me go buy that building for my business. So that's when real estate really tends to boom. And when real estate booms, it booms because prices get out of control really, really quick in the real estate market. Like the average cost of a house right now in the US is about $300,000 on average. So the real estate market has really grown a lot in the US. And then onto materials. So these are companies who mine or transport these raw materials. So the raw materials are gold, zinc, copper, wood, as in forestry, silver also. So if you have to mine it, dig it up, salts, like all that type of stuff, it falls into this group. There are some of these items that are still necessary. But for the most part, if you look within materials, you'll find companies that will last during a recession, because not all items are going to be obsolete. You're still going to need some energy companies around, because the oil that they're drilling, the oil that they're getting out of the ground is going to go not only towards gas, but it goes towards making plastic. The gold and the zinc and copper and silver, it goes in several things: medical devices, remotes, jewelry, processors for computers and tablets, phones, forestry. Wood is not only used for furniture and discretionary spending, but it's also used for paper, for boxes, for landscaping items, the items that are used in construction. So materials go towards a lot of different things, which makes materials an area where you could be fairly safe getting into during a recession or a bear market. So one other thing I wanted to show you guys and cover just really quick, because I told you guys about the competitive advantage, and I'm going to make this really quick. So I wanted to find two different companies that do kind of sort of the same thing and show like why it's important to kind of look at these companies and what they do on a very small scale, like reading about the company, doing your research on these companies. So I'm just going to click on Chipotle really quick. I want to show you guys in the last year what Chipotle's chart looks like. So Chipotle has grown in the last year. And a lot of people would look at this and be like, wait, what? Chipotle grew in a COVID year when we were in a recession, COVID, like Chipotle grew? Yes, Chipotle grew. Why did Chipotle grow? So there's several reasons why Chipotle grew. And it's because Chipotle has a competitive advantage over other companies that do what they do. And when I say do what they do, like literally burrito bowls, tacos, quesadillas is what's on Chipotle's menu. If you've been in Chipotle, you know, you go, you stand in line, they ask you what kind of rice, what kind of beans, and then whatever else you want on your bowl or your taco. And you would think that's so simple. It's a restaurant like Chipotle, and some people would even say Chipotle is overpriced. But compared to Taco Bell, which falls under Yum Brands, Chipotle has an advantage solely because during a time of recession and during a time where the government is giving money to farmers. So if you think about what happened during Trump's administration, towards the latter half, remember there were small farms or just farmers, period, in the United States that were getting money from the government to help offset some of the loss in production or the loss in product that was able to go to market. Those companies that were getting that money actually helped to benefit Chipotle, because if you look at what Chipotle's mission is as a company, and if you look at what their business model is, Chipotle's business model is for wherever they put a Chipotle restaurant for 150 miles around, so a radius of 150 miles or so around that restaurant, they look for farmers. So before they even put the restaurant in an area, they want to make sure that there are farmers that they can go to, and they actually go to these farmers. That's where they get those tomatoes, the onions, the cilantro, the lettuce. That's where they go and get those things. So they want to stay as close to that area as possible. Yum Brands, on the other hand, so Yum Brands owns Pizza Hut, KFC, Long John Silver, I said Pizza Hut, Taco Bell, Habit Burger, Wingstop. They own like several different fast food restaurants. But when you look at what their business model is cheap food. But if Yum Brands was to do the exact same thing that Chipotle is doing with their business model, Taco Bell essentially would have to double or triple their price to do the exact same thing. And it's not advantageous for them to do so. So Chipotle has a business model that no one else other than a small mom and pop, like burrito, taco, Latin, Mexican inspired restaurant can do. None of the other corporations can follow that model like Chipotle. So when we're talking about, government spending, when we're talking about business models and trying to find companies that will last, like these are companies that people cherish because they know, like, okay, they actually care about the small business. They care about the location where they're putting their store. They care about the locals, the people that live there. They care about the environment. So whenever you go to Chipotle's website and you want to find out, well, what farm did they get XYZ from? You can ask Chipotle. Chipotle will tell you exactly where they got your tomatoes from, where they got your lettuce from, where they get the onions. So because we're in a time now where people want to know where their food comes from. And Chipotle can do that. And they've provided on such a large scale. And if you look at where their price was like March the 16th of last year, it was $566. Price has almost tripled since then. So anyway, we'll keep talking more and more about this stuff because it's really not hard. I promise you guys, it's not hard stuff. It's stuff that really, it hits closer to home than you think, and it's really going to really impact you more and more the more you study it, to realize like, oh, okay, this wasn't too far away from what I typically do on a day-to-day basis anyway. So I appreciate you guys listening. I'm gonna go ahead and turn it over to Mr. Levels so that he can get started with the technicals. And if you have any questions, you can put them in the chat.
Cool beans, cool beans, cool beans. Appreciate you as always, Carmen. A lot of great information. I was definitely taking notes. Appreciate everything. Great job. Jump into these technicals. Alrighty. Looking back at Monday, we seen the market open up with a gap for the dollar. Told you guys that I wanted to see the dollar come up and fill that gap in and then give us some bearish momentum. When we got to the levels, price broke up above it and kept pushing. If we look to the left, we'll see this engulfing candle right here. Notice how aggressive that candle was, and then price came right back up into it and then sold off. And then we kind of got this consolidation until today. Price popped up today um, around New York Open right here. From 7 to 10, we've seen this bullish move up. Came back up and filled in what we have right there. Have imbalance right there. We see price come right up in there and then swiftly sells off. Let's look at time and price for today. So this is 2 o'clock this morning. This is 3 o'clock, London Open. We see this setup here, engulfing candle here around 2. Price come back down. take out the lows, come back down to retest these lows, pops back up, gives us that long wick, and then come back down and gives us another engulfing candle here, push up, break back to the upside, and then we see this pullback at 7 o'clock down into this candle, and then we see price pop up to fill in the as Michael Huddleston coined it, fair value gap. So we can see after price filled in the insufficiency here, we get it to sell off to the downside. Time and price, you see market open up at 9:30 New York. Gave you that same move that you got at London open. Up move. The market was bullish for London open, New York open. We got that bullish move, but we got that feel of the imbalance over here, and then we see the market sell off here. So we know that price reached up to fill in this imbalance here to sell off. And so now, being that I am still overall bearish for the dollar, I'll just be monitoring to see if the dollar can get back above this high. If the dollar don't get back above this high, I'll be looking for the dollar to be bearish for the rest of the week. So with that being said, let's look at our currency pairs. All right, looking back at Monday, we was here. And of course, you know, we was bullish for the dollar to start out the week. I wanted to see the dollar move up and fill in that gap to the upside. So we know that our currency pairs move in the opposite direction of the dollar. So we know if I was expecting the dollar to be bullish to start the week out, then we was expecting our currency pairs to be bearish starting the week out. And so looking back at Monday night on the call, we was up in this area, and I told you guys that I wanted to see the Euro USD move in the opposite direction of the dollar, which would be to the downside. We can see the Euro USD did give us that bearish move. Came down, created these nice equal lows right here. That was a beautiful setup for a nice short. So we see the market come back up and then come back up again like 3 times, give us like 3 retests. We get the retest here and then the double top here, and then we see the market come down, take out these beautiful equal lows right here, over here. And what do you see? What is your eyes drawn to the left right here? What's that? Imbalance. Where does the market go to? Boom. Imbalance. imbalance. What does the market do as soon as it feel in that imbalance? Runs away, gets up out of there. Um, let's look at time and price. This is 2 o'clock, 3 o'clock, right here. So this little accumulation right here, market structure right here, is from 2 to 3. We see price buy to the upside, and then what does it sell off of right here? Look, engulfing candle, order block, also coined by Michael Hudson. As y'all know, that is my mentor. So we see the sell off from the order block. Then we see price come back down. As you can see right here, what we do have some imbalance right here. Price come down, don't feel it all the way in, but does come down and gives us a halfway feel of the imbalance, and then price comes back up to give us a retest of this high off of this order block, and then we just see price come down to fill in this imbalance over here, which we should have already been expecting. Because why? We was bearish. We was bullish starting out the week for the dollar. So of course we was gonna be bearish for Euro USD. And then knowing that when we're looking at our charts, we're looking for these indicators that we've trained our eyes to see. So we did get that bearish move out of Euro USD, and then we see today New York opened up, the market finished selling out to fill in this imbalance, and then around 10 to London close, it gives you the opportunity for the buy, the setup for the buy. So we see once we get the imbalance fill here, price dips down, fill in the imbalance. We see price pops up, gives us one opportunity to get in on a retest, pops up, and gives us another opportunity to get in here for the run of the previous high, which would be here. And we get that run. And then when markets open back up, you see Euro USD selling off. So let me see one thing right quick. All right. So yeah, so we gotta just right now, I'm waiting to see what kind of movement the dollar gives us. Like I said, if we get If we can't get back above here, then I expect the dollar to continue to go short. However, we could still see the dollar push up to retest the level, which would um, give us this down move for Euro USD. And we've only had this imbalance touch one time. And then we have imbalance there that was just created off of this up move. And we see price slowly making its way down to feel that in. That's what price is doing right now. That's why price is making its way. Price is like a magnet. Price is drawn to those areas. So yeah. So we'll start looking for the continued bearish move of Euro USD if we cannot get above these highs. Let's look at GBP USD. Um, yeah, we got the bounce off of the structure. Came up, didn't quite hit the overall price target, but it got close enough. I mean, like what? 6 pips. So same as with Euro USD. If we don't get back above this high, then I expect the pound to come back down and probably give us another retest. And then as the dollar get right, I expect the pound to keep pushing to the upside. So I always remember that when we're looking at our currency pairs, we're always monitoring the dollar to see what the dollar is doing because we know our currency pairs move in the opposite direction. So it's a great gauging tool. Moving on to NZD USD. One of you guys, I don't know if you're on the call tonight, but you asked me about NZD. I don't know if it was on the call or in the trade group, but you asked me what I thought NZD USD was doing and where it was going. I gave you the price target of 74.52, and we can see that we did achieve that price target today. So I hope that you made some good money, some good profits off of that, whoever you are. And now, same as with Euro USD and GBP USD, we can see NZD USD starting to sell off to fill in all of this imbalance. Buy side imbalance, sell side insufficiency. So, and as you can see, we do have imbalance to the downside. And we have beautiful lows. And that's the perfect setup for a liquidity run. I also coined by my mentor, Michael Hudson. So that's what I'll be looking at for NZD, USD going forward. And I will be expecting a price reaction off of that imbalance here. So moving on to silver. Silver been playing off of my level. A lot of opportunities there for you silver traders. A lot of opportunities there. Didn't quite make it up to top target. But if you guys have been practicing price action and following price action, a lot of great opportunities up in here. I mean, it's like butter. You see the aggressive move down. You see the pullback up into the order block, up into this down move. You see the pullback, swing high, sell off. Same thing. You see the pattern. Following the trend. Trend is your friend. Come right down. Fill in imbalance. Right off of structure. Come on, man. I'm making it too easy for y'all to get this money, man. Looking at gold. Let me tell you one thing before I go on to gold. Yeah. Yeah. Probably see silver come on down and keep playing off of this structure. Unless, let me see something. Yeah. Mm-hmm. Yeah. So I'll be expecting silver to come on down. Um, let's see what the dollar do. You know, silver move opposite dollar as well as gold. So looking at gold, gold did come up, hit our price target level. So back down like I wanted to the retest this 1786 level again. That was an opportunity for a buy. Know we're gonna get a reaction off of that price level. Once we get that break up like that, come back, retest, buy up beautifully. Golden opportunity. Um these sales up in here was beautiful opportunities as well. Um Gold ain't been moving. Hasn't been correlating exactly with silver. Gold do his own thing. So um even though I want to see gold come back down and retest the structure, gold could just pop on up because I see we got fairly equal highs up here, especially right here. So gold could definitely pop up there. Come up here and retest this these price levels one more time. And then come back down and retest. I haven't been trading gold. I just mark her up so you can see the levels. But if you've been trading her and you've been monitoring her, you should be able to take the levels, do your own analysis, and capitalize off of it. Because you know my overall analysis for gold and silver, we are bullish overall. And we have been riding gold and silver for a long, long time from the downside. Looking at oil, oil retested the levels and ran away. Um, we could see all come down and fill in imbalance that we had to the downside. Yeah. And then continue to the upside. So yeah, I'll be expecting to see um yeah, I definitely want to see all come down and fill in a lot of this imbalance we got to the downside. But I'll just be following price action and see if we start making lower lows and higher lows. I'm sorry, lower highs. So I'll be waiting to see if we start making lower highs and lower lows. But if she continue to pump, then of course I'm gonna continue to stay with the trend because we are bullish overall for oil. Moving on to U30. Let's look at price and time with U30 for today's session. London and New York, today's session. So we will be here. London open, 3 o'clock, 2 o'clock right here. 2, 3. So this little consolidated area right here, aka structure. We see price accumulate and then we see price push to the upside, right? Time and price. We see New York push up. So we know that New York session was bullish. What did I tell you guys? Most of the time, most of the time, most of the time, not 100% of the time, but 90% of the time, whatever direction the market is for London, that's what direction the market is for New York. 90% of the time, we see that London was bullish from when we look for our London setup from 2 to 5. So we see this beautiful accumulation right here, this market structure form. We see 3 o'clock, market opens up bullish, bullish, and just pushes up, pushes up. Look to your left. Notice anything? What did it push up to? Imbalance. Look at this candle here. Let me make this thing big for y'all. Right here. See this candle pushed up, filled in this imbalance, gave us that sell off, setting us up for the next swing, for the next up move, because market was what for London? bullish. Market was bullish. Then they filled in their imbalance, took their profits, set up for the next opening market for the next big players, accumulated in here for a little while. But what direction was the market for London? Bullish. Market opens up New York, doesn't do nothing, just plays around. 9:45, same thing, but it's showing bullish momentum. 10 o'clock gives us that bearish push down, that one last squeeze out for the early buyers. And then we see at 10:15, the market runs away. Comes up, take out all this liquidity, all these fairly equal highs right here. Takes all that out. And rallies to new all-time highs. These are new all-time highs for U30. And so when you're in market conditions like this for U30 and U30 is showing as bullish momentum as it's showing now, you don't try to short it and you don't try to predict when it's going to start selling. That's suicide. That is suicide. So now what I'm doing for U30 is just letting her run out of gas. She can only run up hot so far, so much. So we'll probably see U30 give us some good bearish momentum throughout the rest of the week. This was a good run up though. You had a lot of early sellers off of this run here to snatch this liquidity, fill in this imbalance. That all of that was just a model setting the big boys up for the overall run to the upside for the big play. So while all retail traders seeing this going on, and this was a gigantic sell to the downside, that got a lot of traders, a lot of retail traders interested in shorting the market. And so when price came back up here, you had a lot of retail traders short the market here, and they did go in good profits. But of course, they was greedy, and markets snatched them out, and they sold here and here, thinking that they was too early when they sold here. So they sold here thinking they was too early when they sold here, and sold here. And markets snatched that back. And believe it or not, you had retail traders. Believe it or not, you had retail traders sell here, thinking that they was too early here, thinking that they was too early here when price came back out and stopped them out on these sales. And then they sold here, and that's when the market just went ahead and put the dagger in their chest. and just took everything with it. That's how they do. That's how they play. It's a cold world out here in these market streets. You got to be 10 steps ahead of the game. You got to know what the the institutions, what the market is looking at, and they're looking at the algorithm. It's crazy, but that's what they're looking at. So yeah. So I'm trying to get y'all eyes trained to seeing these things, to seeing these imbalances in the market. Because if you get used to seeing these things, you can look and see this imbalance here and seeing all this selling going on, but never coming up and filling in this imbalance until when? This imbalance that we got right here. From this thick bearish candle, this drop down right here that we got on February the 16th. And then we just seen selling. Price come back up, never come back up and fill in that gap. Selling. Now look. Check me out. This where we at. This is that gap. Look. Never come back up and fill in that gap. This high doesn't come back up and fill in that gap. You know this one doesn't. This one doesn't. This one doesn't. Nothing. Everybody, all retail traders is waiting for a big sale off of U30. They're thinking this is it. And the market makers and the big banks and the institutions, the hedge funds, central banks and everything, they're just accumulating orders. And then when does this gap finally get filled in? When we see this gigantic price swing and it takes it all in one swoop. Don't even see them coming. They just, and it's a wrap. It's a wrap. You're out of there. But y'all on the right side of the market and we ready. So yeah, man, for now, enjoy the fruits of your labor. For everybody out there that's been doing their homework, like my man Jay, like my man Joe, like Jamaica, Tam, like everybody that's doing their homework, man, and seeing what it is that I'm showing y'all and teaching y'all, and benefiting off the fruits of y'all labor, man. So right now for U30, man, let's just let her run hot, and I want to see if she come back down and get below this low. Then I'll be interested in starting to look at some shorting opportunities. But until then, and only until then, I will be buying off of the levels, structure that we know to look for. So with that being said, I'll stop my share. And I let Ghost go over anything he got for us.
What's going on, y'all? How y'all doing?
What's going on, broski?
What's going on? It's a beautiful, beautiful time. Beautiful time to be alive in these market streets, as you say, right?
You better know it.
Hey, man. I'm gonna start off with this. Since you was on U30, I'm gonna start with the U30 because that's where you was at. So I'll go there myself. Same thing, basically, same thing you said. I am looking at this level. Hold on, let me make myself a little bigger. Split it up. Could y'all see my screen? Oh no. Yo.
Not yet.
Oh, okay. I didn't even share screen yet. My bad. Okay. All right, y'all can see it?
Yes, sir.
Yeah, like you said, basically, you know, I've been looking at my U30 on a couple different ones. Let me just do this right here for this purpose. Okay, give me a second. Basically, it was in the consolidated area. We was in an overall uptrend. Everybody was looking for the sell, but every time it got to this level right here, the buyers kept pushing it back up. So one thing that I've learned with trading, that when we're in a consolidation right here, you know, sometimes a lot of us, including myself, you know, don't wait till the consolidation breaks, and, you know, or we've been taking sells and buys pinging off. But what I noticed this time was, well, for the past few weeks, I just been buying. I've been buying up the U30. I just been buying a dip, because even though it's been giving us nice bullish, bearish moves, it's nothing compared to the bullish run after it catches everybody out there. So I just been being patient and waiting. And even though up here, as you were saying, all this liquidity up here, all these orders, what I noticed on the run was we still kept making higher lows. Even though it couldn't bust this, but we started making higher lows. I knew these were, you know, the steps. If we go into certain time frames, you'll start seeing the steps. And I knew that the market was about to run up. Market was about to run up. I was just waiting for the perfect opportunity. Hold on, let me go over here. The perfect opportunity to get my confirmation that it was time. There we go. Excuse me. There we go. The steps. It was a no-brainer. This right here was a kill shot. If you wanted to wait for the confirmation, this right here was the kill shot. You take it to a smaller time frame. After it blew through it, it wicked straight off of it right here. Perfect. And I already knew it was time to go, but I was already in. And this was my second position I got in once it whipped perfect off the kill shot right here. That was an entry. This was an entry. These was all confirmations. This was the first confirmation that the bullish market was starting back. Right here, let me see. Excuse me, give me a second. For me, anyway, this was my first confirmation. So hold on, guys. I didn't mean to do that. This right here was my first confirmation for me. And then I start looking for the up move after this. I started looking for the continuation to the upside. This was a confirmation. This was one. And once it came back and kept holding on to this, I knew it was time to go, because we're already making higher lows, and we're already in a bullish market. So these was definitely opportunities to get in after waiting for confirmation. This was a first move. And if you didn't take it here, you could have waited and took it here because it kept building steps to the upside. And this was my last entry point right here. This was the last confirmation for me. And then it was gone. It wiped out the liquidity. So I think once you start getting to these levels, if you look on this side, once you start getting to these levels of consolidation on the top and the bottom, you got to start really going into your smaller time frame and looking at the candles and seeing what you're starting to learn, what it was forming, so you could start seeing a move before it happens instead of afterwards. So you start looking at that a lot, practicing it a lot, even in your back testing. So when it starts to happen in real time, you can start seeing these moves before it happens instead of missing a move or taking a loss and saying, oh, wow, this will happen. So consolidations is a great way. Once it gets to the top or the bottom of the consolidations, that is a great way to start looking for candle formations and higher lows and higher highs, trend lines or low lows and low highs to see, to start to figure out which way the market, what is it going to do? And what I like to do is start to, of the consolidation, I will start looking at the 50%, the mid-level of the consolidation. So I can start looking at the candles and see what is it starting to do in these mid-levels of the consolidation. And when you see the consolidation, you see this was a New York open, this was a London open, this was a New York open, right at the 50% of the consolidation. So these is little things you could look for, and like piggybacking off of what Hop said, whichever way it opens on the London, it usually follows in New York. So you can kind of get an idea when the market is about to take off, and you can start looking for it. Don't be the first to get in. Wait for the confirmation. Don't be the first to get in. Just wait for the confirmation. You understand? And then you could take off. Or you could just be patient and wait for it to break the consolidation and test it and then and took it straight up. But, you know, a lot of times some of us are not that patient. But those are things you could start looking for. As far as the Jeep, and that's what I got for U30. I am going to wait for a pullback and just look to buy again. Because when I've been selling off this U30, my TP hits sometimes, but sometimes it doesn't. And it just starts to continue back to the upside because this U30 just been running. It's just been running. So I think the safest play is to just wait for the pullback, wait to start seeing the market exhaust itself and start looking at candle formations on a smaller time frame and look for another buying opportunity. That will be the best bet for the U30. So now I'm going to go to GJ. I will go to GJ. Same situation. It has been pumping. I just actually started trading this again, and I've been doing really well with it. I am looking for it to come down. This may be a buying opportunity right here, but it may come down to around the 50% or 60 fib level. I'm thinking I'm not going to be an early buyer and take the drawdown. If it does pop off of this level right here, it's fine. I'll just look for another opportunity. And, you know, it has more room to come down for me right now than to go up. So it wouldn't make any sense for me to take the buy off this level because we know that it could possibly stop right here and come down, and it's still got all of this room to come down. The risk is not worth the reward. So I'm going to wait and be patient and see if it comes in this 51.60 level, and I'll start to look for another opportunity to continue to the upside. It's been correlating with the US 30. When this pump, the US 30 pump, and vice versa. So that's what I'm gonna be looking for with these two. I'm still looking at the buying opportunities. I'm gonna be patient. I'm not gonna take the short. I'm just gonna, unless the market reverses on me. It's up until it's down, and it's down until it's up. So I've been bullish on those two. As far as gold, gold has been tricky. For me anyway. Gold's been tricky. I've been dipping in and dipping out. I've been like, breaking even on gold, winning some, losing some. She been bearish since the 6th of January, just coming down. But I'm starting to see higher lows being formed, even though it's still coming down. I'm waiting to see how it's going to play. If it breaks over this area right here, I'll probably start looking for a buy. But I'm just waiting right now because gold has been doing what it want to do, hasn't been following what I like to see. It's been violating the stuff that I like to see to take my trades. It doesn't, it's been violating a lot. So I'm just going to wait and see. I would like to see gold push back up. It's definitely hanging around this area where it's been bounced, where it's been bouncing off of. It's been bouncing off this area. I didn't give the bounce that I wanted to give. It's still hanging around here, but on a smaller time frame, it is making steps to the upside. So I'm going to just wait for some further confirmation before I jump into a gold buy. I'm just going to wait. I'm just going to be patient because I know a lot of people made a lot of money in the beginning of this week. And at this time, this was when they want to take the money back. And if you lost in the beginning of the week, they want to take more back. So I just say be patient. I'm looking for buy bias on all three, even though we've been down. We've been on a downtrend on the gold. I am looking for it to pop up soon, but I'm going to wait and be patient. But that's what I got for the 3 pairs, because those are the only 3 pairs that I've been trading is US 30, GJ, and gold. That's the only pairs I've been trading as of late. So when I see some candle formations tomorrow morning, maybe if things start to go, unless it happens at London, because I'll be asleep during London. If in the morning, I'll be sure to hit the Telegram and tell everybody what I see. But that's all I got right now for the night.
Cool beans. Great information, bro. Great analysis too. Fire analysis. Yes, sir. So now I'm going to stop the recording and take any question.